Good morning, everyone. We're just going to wait a few minutes as all the attendees trickle in. We'll just give it another minute or so here. Just seeing the number rising of attendees. So we'll just give it another minute before we get started. So thanks for your patience. Okay. So I think we will get started here. Good morning, everyone, and welcome to the Alberta Inclusive Innovation Initiative series, or better known as AI3. This is the final webinar in a four-part series that's hosted by Ryerson University's Diversity Institute and made possible by the generous support of HSBC Bank Canada. Thank you to all of those who have joined us for the previous webinars, as well as this one today. My name is Joanna Diorio, and I'm a program manager for training and entrepreneurship at Ryerson University's Diversity Institute. Today, I am dialing in from beautiful and sometimes sunny Toronto. Toronto is in the dish with one spoon territory. The dish with one spoon is a treaty between the Anishinaabe, Mississauga, and Haudenosaunee that bound them to share the territory and protect the land. Subsequent Indigenous nations and peoples, Europeans, and all newcomers have been invited into this treaty in the spirit of peace, friendship, and respect. Our regional hubs and partners across Canada similarly gather on the traditional territory of many of Canada's Indigenous nations who have cared for these lands since time immemorial. The Diversity Institute is delighted to present the AI3 webinar series. These webinars are designed to provide early-stage entrepreneurs in Alberta from underrepresented and underserved groups with the advice and tools they need to grow their business idea into a well-crafted business plan. We're really proud to be working with newcomers, LGBTQ+, youth, women, Black, and Indigenous peoples alongside other racialized individuals to help develop their entrepreneurial skills and plan their business ventures. The Diversity Institute is committed to advancing diversity and inclusion as a pathway to economic success and entrepreneurship. Through our research on inclusion, innovation, and economic growth, the Diversity Institute develops impactful programs such as the Newcomer Entrepreneurship Hub and the Women's Entrepreneurship Knowledge Hub, alongside reports such as Diversity Leads 2020, which was actually the largest Canadian study to date on board diversity and leadership. To learn more and to stay up to date on events and information at the Diversity Institute, check out our website and follow us on LinkedIn and Twitter at RyersonDI. So, without further ado, we're going to begin our presentation. I'm really excited about today's presentation as it builds upon our previous conversations for those of you that were able to join us in prior webinars. And that started with knowing how to validate your business, putting your business plan together, putting your financials together, and now getting ready to meet with your bank. For many entrepreneurs, meeting with a banker, and not just entrepreneurs, for anybody, I think, meeting with a banker is a nerve-wracking experience. And that's because accessing financing capital is often filled with uncertainty. You may ask yourself, what is the lender looking for? How will they evaluate your business? What kind of loan do I need? And how do I even know if I'm even ready for a loan? So today, it is my pleasure to introduce Shannon Pestun, who is the Senior Advisor, Banking and Business with the Women's Entrepreneurship Knowledge Hub. And she's here to share her knowledge with us. Shannon is a proud Métis woman, and through her consulting company, is the Senior Advisor, Business and Finance for the Women's Entrepreneurship Knowledge Hub, which we also call WEC, which has been established to strengthen the ecosystem supporting diverse women entrepreneurs as part of Canada's Women Entrepreneurship Strategy. Shannon is leading WEC's work in mapping Canada's financial ecosystem and building programming that increases women's access to financial, social, and entrepreneurial capital. A former business banker herself, based in Calgary, Shannon brought women's entrepreneurship to the forefront of ATB Financial, creating and leading the bank's first dedicated strategy for women entrepreneurs. Previous to her 10-year banking career, she worked as a strategic marketing and communications professional at a leadership level. Shannon's commitment to advancing women's entrepreneurship has been widely recognized. In 2019, she was one of 7 women appointed to serve on Canada's Women's Entrepreneurship Strategy Expert Panel. She was also recognized as a She Innovator by She Innovates Alberta, a pilot chapter for UN Women and a finalist for the Diversity Ambassador of the Year Award by Women in Finance Canada. Over the next hour, Shannon is going to go over how your banker will look at your business and how you can prepare for your bank funding journey. Following her presentation, we're thrilled that Shannon will be joined by Pete Molenaar, who's the Senior Vice President and Head of Commercial Banking for Western Canada at HSBC Bank Canada for a Q&A session. At that time, you'll have an opportunity to ask your questions about the lending process. So without further ado, please welcome Shannon.
Hi, good morning, Joanna. Nice to see you, and great to hear that your weather is nice there too. We're beautiful and sunny here in Calgary. Before I begin my presentation, I would also like to acknowledge the land that I'm on and that the work that I do takes place on the traditional territories of the Blackfoot Confederacy, which includes the Siksika, the Kainai, and the Piikani, the Tsuut'ina and Yahi Nakota nations, the Métis Nation Region 3, and all people who make their homes in the Treaty 7 region of Southern Alberta. Thank you so much. And I've had the pleasure of being on this journey now for all of the webinars in this series. And like you, I'm happy to see the progression because we started really with how to validate the idea, which is really critical throughout the stage of being able then to put your business plan together and knowing how to read, and prepare your financial statements, which all culminates to getting ready for the meeting with the banker. And I will say, as a former business banker, I know that it is a nerve-wracking experience. And when you said that in your opening, I can certainly attest to this sitting on the other side of the desk. And I think that the financial industry, we haven't always done a really great job at helping entrepreneurs prepare for that moment that they come in to meet with us. And like you said, those big questions, like what are we looking for in the lending process? I'm hoping to be able to get through some of that today. I am going to share my screen with everyone, so just bear with me for one moment while I just get myself set up here. Okay, let me know when you can see my screen.
Looks good, Shannon.
And I'm really sorry, I was supposed to do all these slides as I went along, wasn't I?
That's okay.
Thank you. So today we're talking all about what you need to know about the financial capital. Joanna, you were kind enough to introduce me, and you've given a great shot at my background. And I would like to say that while my work is really focused around women's entrepreneurship, I would be remiss if I didn't say that it is also focused on building a more inclusive entrepreneurial ecosystem. I think one of the things that we've seen coming out of COVID is that COVID certainly put a spotlight on where inequities exist in our systems. And the financial system, which is perhaps one of the most powerful systems in the world, also sees its own inequalities. And we see this when it comes to accessing financial capital. So we're going to go into a little bit today and talk about really what is the role of financial capital. Because I think it's important to take a step back and think about this as capital is the lifeline of a small business. And you can think about financial capital as really being the funds that come from either internal sources, such as yourself as an entrepreneur, or from external sources. But the reality is that most entrepreneurs at some point are going to need external capital as they start and grow their companies. The other reason that capital is so important is because companies that don't have enough capital We see the result of this in lower sales, lower profits. These companies are more likely to stay smaller and create fewer jobs, and they're also more likely to fail. And we do know that most businesses will fail due to a lack of cash. So it's really important to note that we can't underestimate the importance of financial capital. And recognizing that we're dealing more with entrepreneurs who are at the startup phase, I think it's important to put a light on the fact as well that often we think about the money that we need to start our businesses. We might have a budget created, we might know what we need to start, but the financing journey really moves as you grow as an entrepreneur. Things will start happening in your companies, you'll start seeing different growth opportunities, and this is where financial capital starts taking on a life of its own that matches the path of your company. So, reason companies need capital. You're going to need capital to help with your startup costs. Capital also plays a role when it comes to improving stability, which is really important in the company, profitability and growth. Capital will also be able to help you support with your day-to-day operations. It will allow you to recognize growth opportunities that focus on increasing your revenues. It will also help you purchase assets, and that might be equipment, buildings, or materials. And it also can be used to help restructure existing debt. And we see this more commonly used in bigger companies. But what happens is some companies will have multiple debt structures, and capital, when you restructure, you're able to sometimes reduce some of the higher interest rates if you have multiple loans. The financing journey is one of those things that is going to be personal to every single business. And so what's true if you look at one of your friends or a colleague of yours that has a business might not be true for your business. And it's really important that as entrepreneurs, you ask yourselves, what stage is my business in? Because what stage your business is in is going to start dictating the types of capital that you're going to need. Is it to hire employees? Is it to expand into a new location? Where your business is at is going to play a really important role. The other thing that we've talked about already is, do I have a business plan? And a business plan is really going to help us understand as lenders where you're taking your business, what your vision is, what's unique about you, and helping us understand what the plan is for your growth. Another really important question for entrepreneurs to ask is, what type of capital is right for my business? There are many different types of capital. There's debt capital, which is about borrowing money. There's equity capital, which is about inviting investors into your company. And there are other ways to finance your company as well. So knowing what type of capital is right for your business is also a big consideration that you're going to have to make. The other piece that you want to know is really understand about what your current financial position looks like in your company. You want to be really clear on why you need the financing and how that financing will be used. So perhaps you might need financing to help you purchase a new piece of equipment. Maybe let's use a pizza company for a moment. Maybe you need some money to help you buy a new pizza oven. And that money will be used to purchase it so that you can grow your revenues. When you're going in to meet with a banker, you also need to know how much you need to borrow. So how much is that piece of equipment? Or if you are looking at an equity raise, you need to ask yourself, how much do I need to raise? Finally, you're going to have to ask, how am I going to repay the loan? Or if it's equity, can we meet the returns our investors are expecting? This is also why your business plan plays such an important role, because it will address all of these questions. I do want to break down some of the myths that we see around financing, because I think for entrepreneurs, we have assumptions, we hear stories from other entrepreneurs, and quite frankly, it's a bit of a complex system. So let's get into some of the myths. The first one is that you can't get financing as a startup company. There are certain avenues where entrepreneurs can go to get startup financing. So often we will take a look at what your projections are and what you think the company is going to do. So absolutely, as a startup, you can access financing. Another myth would be that banks are our only source of capital. And while banks are the #1 way that entrepreneurs are going to finance their companies, they aren't the only source of capital. We see, as I mentioned earlier, equity financing. We also see things like crowdfunding, and we'll get into some of those in a little bit. Another myth is that you can't borrow small amounts of money. Many entrepreneurs think that they have to be borrowing hundreds, if not millions of dollars to be able to be taken seriously from the bank. There are small loans that are available to entrepreneurs that come in different forms. And again, we'll talk about those. Another myth that gets tied up are that all loans are the same or that all lenders are the same. And by all lenders are the same, we expect sometimes that their expectations are the same. And that couldn't be further from the truth. There are different types of lenders who value different things, who have different interests for investing in companies, and we'll explore some of that as well. Another myth is that you have to have hard assets as collateral to get a loan. It is true that most loans need some type of security. And the reason that banks take security is because they're making sure that they can cover their losses in the event that you happen to default on your loan. But there are some loans that you don't require collateral for, and collateral is a certain piece of your security that you will get to negotiate when you get to meet with your banker. Another myth that I see quite often is there's no such thing as good debt. When I was growing up, my dad always wanted me to pay everything by cash. And if I didn't have the cash, he always said, don't buy it. But debt can be a good thing when you're using it to help you grow the company. So if you're investing in your company and you see taking on debt as an opportunity for you to generate more revenues, then debt is a good thing. Another piece is that we're looking so much these days and we hear so much about venture capital that often we think equity is better than debt financing. And while it might be a hot topic and we might focus on it a lot in the tech space, equity is right for some companies and it is not right for others. So that takes us into exploring the different types of financing. And there are three primary types. So you've heard me say debt financing. And debt financing here, you can really think about the banks, but you're going to be increasing your capital, so increasing your cash. You're going to borrow funds, which you then repay over a period of time with interest. What's important about this is that you're borrowing, and there's a term of repayment that has a set time and set interest. And that's what makes it debt financing, is because you actually have an obligation. Equity financing is where you're going to increase the capital in your company by raising money from investors in exchange for shares in your business. So here you can think about angel investors, you can think about venture capital. Another emerging type of financing is alternative financing. And this is a way of increasing capital or cash without taking on debt or giving up any type of equity. And again, we'll get through those as we move through the program here. So I wanted to take a look at a little bit of the characteristics of debt versus equity. And I think the best way to do this is to take a look at, how are the funds used, what relationship it has between the lender and the borrower, how you repay, what the security looks like, how risk shapes, and as well, how involved that type of funder is going to be. When we look at debt, it's all about repayment. What any lender is going to be concerned about is, can you repay that loan? So they want to be concerned about that because you're borrowing money from them. So they're expecting that you're going to pay it back. When you have this type of scenario, you have a relationship where your lender is your creditor and you are a borrower. Well, again, when it comes to repayment, we mentioned earlier that when it comes to debt, you're going to have a regular payment to your creditor. It could be a bank, it could even be an online lender, it could even be friends and family, where you will have principal and interest. And you're also going to have a fixed period of time for that loan. So you're going to have an agreement that sets out all of these terms, and you will have to uphold your side of the agreement. When it comes to debt as well, we can see unsecured or secured loans. And again, that will depend on the type of loan that you're looking for and how strong you are as a borrower. And when I say how strong you are as a borrower, what I'm really saying is how creditworthy you are, how big of a risk you are to the entity that's borrowing you the money. The other part about risk is, again, when it comes to debt, it is lower risk to the lender because the lender is looking at how you have performed in the past and how your company has performed to date. So you are less risk in a debt situation. One of the biggest parts that people like about debt financing is the fact that there is no involvement as an investor from the bank. So once you have paid off your loan, you have no further commitment. On the flip side, when we take a look at equity, where debt is all about how you're going to repay it, equity investors care about profitability and growth. Those are their levers. So when we take a look at types of funds where you're borrowing money from a lender, you're actually getting an investor inside your company. So they are owned funds. So that People come into your company, they give you some money, they are now a shareholder, which makes them an owner in your company. When it comes to repayment, when you're looking at equity, because they're looking at profitability and growth, there's no regular payment here, but you will be paying out dividends to the equity holders as the company meets certain milestones. So these investors are going to be waiting to be repaid at a bigger pay date. So unlike a bank where you have a monthly payment, it is not true in equity. And also these investors expect this to be higher risk. So they know that they may actually not get paid back, whereas the bank is banking on you to pay the loan back. Again, that because of this relationship, it's always unsecured money with equity. They can't take any security position in your company. They are taking on all of the risk. One of the biggest drawbacks to equity that we hear is that often the investors are going to take a significant involvement on the management team. They may even want to be part of your board of directors. So you lose a lot of control when you're dealing with equity investing. When we take a look at the pros and cons of debt financing, so I'm going to go kind of back and forth here because I want to explain some of the pros and cons. The pros to debt financing, so this again would be a lending type of environment. You get to maintain control and ownership of your business. The cost of borrowing is actually going to be tax deductible in many ways because you can write off things like borrowing fees and interest expense. The other part that's nice about it is that you'll have some sort of predictability in terms of your cash flow because you know what the repayment terms are going to be because you've established those in your credit agreement. So you know that every day on the first of the month that a loan payment will come out. It might be the 15th, it might be the 31st, but the point is that it's always a consistent payment. And as I mentioned, once that debt is repaid, you get to walk away and you don't have a further relationship or commitment to your lender. This makes this type of financing less costly for small business owners. However, every type of financing has its pros and it also has its cons. And when we take a look at the cons to debt financing, the biggest challenge has to do with your cash flow because your loan repayments begin almost immediately after your loan is approved. So the minute your loan is approved and the minute that it's actually sitting in your bank, you now have a repayment. So if your cash flow isn't where it needs to be, that could put on a lot of stress to the business owner. As well, the loan has a fixed term and it must be repaid by a certain date. So you can't suddenly say, well, I can't afford to pay it this month. Can we make the term of this loan longer? Banks and other lenders that have an agreement with you will expect you to uphold your end of the bargain. Loans are generally secured by assets of the business or by the owner's property. And that's referring to, again, a secured type of loan. And while I mentioned that there are unsecured loans, depending on what your loan is for, banks are going to be looking for how they can protect their investment. And they will want to look at how they can secure the assets against which they're lending to. And there's also something we call with annual reviews with banking, or where you might have to be reporting on how your company is performing. The bank has it within their terms that they may ask you to have certain covenants that are met or certain agreements that you meet. So things like you won't let your equity fall to a certain position, or that you'll continue to keep a certain amount of working capital in your company. The banks, when they set up the terms with you, will tell you if there's going to be specific reporting requirements that are required. The other thing is that every time you take on debt, it does impact your credit rating. On the other side, when we take a look at equity financing, there are pros and cons here as well. And the biggest pro is that often with equity financing, you're able to bring in more money than you would be with debt alone. So you're expanding your borrowing power. At the same time, you're also benefiting from some of the networks that your investor has and using their borrowing power as well. It's also, as I mentioned earlier, because there's no set terms of repayment, we call it patient capital because there is some flexibility of how the dividends will be distributed. Investors also provide additional expertise and credibility. Because they're sharing the risk with you and because they're invested in your company, they have an interest in ensuring that your company is successful and that you're able to meet the targets that you said you'd be able to meet when they invested in your company. And also you improve your company's credit rating with your suppliers because again, you have this extra bench strength in your business. The biggest cons, on the other hand, is that you will have a loss of control and reduced ownership. So if you're an entrepreneur who doesn't want to give up control, who doesn't want somebody calling the shots in your company, and you're very passionate about the values you have, equity financing might make that more difficult. It also takes a lot more time and energy to be looking for equity financing because you will be pitching to numerous investors, and most often your company will hear a no. So you really have to be resilient, you have to be persistent, and you have to just keep looking for multiple avenues to pitch to. If you are successful at raising equity capital, you will see that you have increased expenses. You're going to have more complex legal needs, more complex accounting needs. But overall, equity financing is harder to obtain for entrepreneurs. When we look at the sources of financing, this is where you can actually go to get the financing. So we have internal sources of financing always. As a person, you have the opportunity to invest in your company. You generally will be the first person to invest in your company. So we often will call this sort of a bootstrapping method, where you will put the personal investment in your company. The other way to grow it is once you have equity in your company and you're keeping earnings in the company, you will have shareholders' equity or owners' equity, and you can grow your business and access that capital to invest in your own growth. When it comes to external sources of capital, when we look at the debt side, you might be able to secure a loan with friends and family. There are also avenues for peer-to-peer lending, and we'll look at that in a moment. And there are many different types of lenders, which I will also get into. When it comes to external sources of equity, again, you can have friends and family, because in this option, friends and family are now investing in your company as shareholders. There's new platforms like equity crowdfunding that are now in Canada. This is new as of about 5 years ago, where Canada's Securities Commissions did change its regulations. So now you can go to an online platform to raise equity through crowdfunding. As well, you'll often see many business incubators and accelerators that are a pathway to helping you connect to angel investors and venture capitalists, which are both part of external equity. When I mentioned earlier, there were alternative sources of financing. These are some of them. There's rewards-based crowdfunding, which many of you might have heard of, such as Kickstarter. ATB Financial also has a crowdfunding platform for Alberta-based businesses, which is known as ATB Booster. There are also grants, which can be considered as free money because you don't ever have to pay back a grant. As well, one of the benefits is that if you're successful in obtaining a grant, you can use this equity in your company, and lenders will be able to look at it as equity in your company. And there are different types of grants, from research to helping you with jobs, to helping with training of your employees, and as well helping you exporting. And if you went to www.canada.ca, there will be a platform there which will help you start searching for grants. Another avenue that we're seeing a big rise in is donations and prizes. For example, pitch competitions. The Business Link, which is in Alberta, is actually launching a pitch competition for Indigenous and immigrant entrepreneurs. And I believe the closing date has now passed, but we're starting to see a lot more of these pitch competitions because they do play such an important role in helping you market your business and helping to get that validation that you can then go to lenders and say, I was able to secure a pitch competition, or it just shows the lenders that you have something, you have some traction, and you have a proven method of success. Other sources of financing might include things like merchant services. And that's if you have a merchant terminal where you're accepting Visa or MasterCard, you can actually receive an upfront sum of money in exchange for a slice of your future sales. So if you do have merchant services, that might be something that you can access if you needed cash in the short term. Then there are things like trade credit, which helps you buy goods or services, and you can pay your supplier at a later date. And finally, there's the leasing option, which allows you to use an asset, but you don't actually have to buy it. And if you're a company that uses accounts receivable, or you extend credit to your customers, there is a financing avenue called factoring, which allows you to sell your receivables to a company. They will give you an immediate cash injection. So lots, as you can see, that happens in the financing space. And if it's not already complicated to know how many different financing sources there are also several different types of lenders, making this an even wider web. So I'm only focusing on the debt because we're going to have Peter Molenaar joining us from HSBC soon. And I'll be reviewing some more of the things that the bankers are looking for, but we're only going to be covering debt in this session. So when we take a look at where you can go to find lenders, a lot of people think banks and credit unions are the only sources. But we have several development lenders in Alberta and across Canada. So there are development lenders such as Alberta Women Entrepreneurs, which focuses solely on women entrepreneurs, Futurepreneur, which focuses on entrepreneurs who are 18 to 39. There's also Community Futures, which focuses more on rural Alberta, rural Albertans and rural Alberta businesses. Then we also have the Business Development Bank of Canada, as well as its sister organization that looks at exporting, which is the Export Development Canada. And then we have some lenders that are focused specifically on agriculture, which include Farm Credit Canada and Agriculture Financial Services Corp, which is also known as AFSC. At the same time, Indigenous entrepreneurs also have different types of lenders that they might be able to access. And if you went to NACA, which is the National Aboriginal Capital Corporation, they will be able to show where all of the different financing institutions are across in the country. In Alberta, for example, we have the Apitagosan Métis lender. We also have a number of different AFIs in Alberta. We're also seeing fintechs really come into play. So there's a group called Lendified as an example. They will do online loans of up to $150,000 to help you access money for your company. And as well, we have emerging lenders that don't fit a category of debt or equity or crowdfunding. And one of these emerging lenders is SheEO, which is also targeted specifically to women entrepreneurs. But these are interest-only loans, and the loan funds are pooled from women who give as what we call radical generosity, and there's a loan fund that gets distributed to different women entrepreneurs that the activators select. So some of the things that can be financed, I think this is an area also that tends to hold up entrepreneurs, because what can, often you'll think you can go to the bank and it's, you might want money for a certain purpose, but then you go there and you realize that you actually can't have that financing purchased. And I'll be honest, when I first started banking, I thought it was going to be really easy to lend out money. And I didn't realize how many parameters and how many conditions needed to be met for the banks to lend out money. But some of the things that can be financed would be things like leasehold improvements. If you're improving a space that you're leasing from, or making renovations to it, if you need to buy equipment or real estate or inventory, even if you need operating capital to help you with advertising or marketing or website costs. And there's also, as I mentioned, restructuring debt. Anything that really ties to growth or revenue in your company is an opportunity for you to discuss lending with your banker. Again, the bank is really, they're conservative lenders, so they're really going to want to make sure that you can repay that debt. And so the most important thing you can do as an entrepreneur is show how what you want to buy or what you want to do is going to help your company grow, produce revenue, and also allow you to repay that loan. Some things that can't be financed. As entrepreneurs, often we have to cover our own salaries. And the reality is many businesses don't allow an owner to take a salary in the first few years. But still, that is not something that can be financed. Nor can things like franchise fees be financed, or things that are intangible, such as a reputation of a company or its business name. The other thing too is that banks won't give you money for you to purchase stocks or shares or other non-productive investment avenues. And that also includes things like speculative purchases like land. There are different types of loans as well that you'll see from the banks, and some of the common terms that you'll hear is an operating line. And an operating line tends to, what is the other word that we use, is a line of credit. And that can be unsecured or it can be secured. But an operating line is really a type of financing that allows you to keep up with your working capital, or known as the capital that you're going to need just to keep your business operational. Then there are term loans, which can be short-term or long-term, also unsecured or secured. And term loans are repaid at a certain, the term around that would be a certain interest rate, again with a fixed term, so you know what you're paying. Unlike an operating line that's used for day-to-day, a line of credit would be open to you 365 days a year as long as you're in good standing, whereas that term loan does have an end to it. There are also government-backed loans. And in Canada, we have the Canada Small Business Financing Loan. And that loan is actually offered through the banks, but it is government backed, which means the government shares in some of the risk. So for some of the entrepreneurs, this is a great avenue because the government basically is saying to the banks, we're going to back this loan with a guarantee, which gives the bank additional comfort. Other lending facilities would be things like credit cards. So you would be familiar with MasterCards or business visas, as well as letters of credit. Now, this is the meat of the material. So what's on your banker's mind? Well, every banker has their own style to lending. There are certain parameters that all bankers use. And what we call this risk framework is the 5 C's of credit. And those 5 C's are about character, capacity, capital, collateral, and conditions. And I'm going to spend some time talking about each of these. Character is by far the most important lending consideration. And this matters because banks want to lend to people who are responsible, that have a proven history of being trustworthy and credible, and who are able to meet their debt obligations. As I mentioned to you before, bankers only care that you're going to be able to repay the loan. That's their primary consideration. And so to be able to assess this, they'll often rely on third-party credit reports, but they also rely a lot on their gut and what their past experience tells them about the type of business you're in, and maybe even the industry, or even where you are. So bankers will take a look at your credit history and third-party reports. So that would be things like your Equifax, which would tell bankers what kind of a credit score you have. This is also an opportunity for you to talk about your business experience and the kind of credentials that you have, what types of references you can show, have you won awards, or what is your reputation in the industry? And as I mentioned, your existing relationship with lenders is really important because it gives confidence in you as a borrower. So building a relationship is really, really important. Ways to improve your character and your chances in this area is really to make sure that you review your credit report. Actually, any one of us can call Equifax and get our credit report and view it. And there often are discrepancies on it. I saw many instances where entrepreneurs would say, well, I cleared up that debt and I don't know why it's still showing. If there's any blemish on your credit report, it's going to lower your score. And that's not what you want in a lending situation. You can also look at things like paying down or consolidating your existing debt, but also make sure that you're not late on payments. So our tips here would be know your credit score, build a relationship with your banker, demonstrate your financial management skills and discipline. And something that I always say when I was working with entrepreneurs was don't hide bad news. The last thing a banker wants is for you to tell a story, hide something that gets uncovered later, because ultimately that ends up hurting the trustworthiness and the credibility that they have in you. But character is also really important. I mentioned gut because this is the only space in the whole credit assessment where the banker has to get to know you as a person. And these aren't things that they can read on a financial statement. The next C is what we call capacity. And capacity is all about your ability to repay a loan. And this measures like how you can take on new debt against what your existing debt looks like. So capacity considers all of this. So as a business owner, you want to make sure that you're generating enough cash in your company so that you can cover not just your operations, but all of your debt obligations as well. And this is all about cash flow. So this is where your accountant came in. Shauna Frederick, if you were on the call last week from Frederick OTG, she gave us a look at what some of the important levers were that bankers are going to be looking at. And here's where these ratios come back. So bankers are going to be looking to see that you have enough cash in your company to cover your operations and your debt. And they're going to assess this through financial ratios, which include working capital. This measures how liquid your company, how quickly you would be able to liquidate your assets if you needed to. And as well, looking at your debt service coverage ratio, which means how much money do you have to cover your debt? So when bankers are looking at this, they want to make sure that out of your working capital, for every dollar of debt you have $1.20 to cover that debt. Or sorry, of current assets against your current liabilities. Then when they're looking at your debt, they want to make sure that for every dollar of debt you have, that you have $1.25 to cover it. So again, really important that you know exactly what your cash flow position is. And things that you can do to improve this would be to pay down or consolidate your existing debt, because that's lowering your existing debt obligations. Also being really, really disciplined in your expense management and how you're collecting from your customers, how quickly you're collecting your cash. And sometimes this even involves reviewing your pricing strategies, because you may want to be able to increase your prices to be able to increase the cash that you'll have to be able to cover your debts. This is where, on my tip, I would say really work with your bookkeeper or your accountant to understand this part of your company. Capacity, again, in a lending situation is incredibly important. And you'll want to know these ratios before you go to the bank. Nothing impresses a banker more than when you can start talking their language. The next C is what we call capital. And capital is the equity that you have invested into your own company. This is all about what skin in the game do you have? Because lenders aren't going to be the only one to invest in your company. They want to make sure that you're also invested in your company. And if you've ever bought a house, you'll know that you might pay a certain purchase price, but the bank's not going to lend you 100% of the purchase price of your home. They use something called a loan to value ratio. And it's the same thing in business. Bankers will assess based on the collateral, based on the loan, what lending value they're going to give you. But when it comes to capital, they also want to make sure that you're not too leveraged, that they want to make sure you're not using too much debt to grow your company. So some of my tips here would be to make sure that you're keeping an investment of everything that you've invested into the business. Keep your earnings in your company, because if you need financing, you're going to want to show that you have equity in your company, that you haven't depleted the company of all of its cash or all of its equity. And also an important piece, particularly for startup entrepreneurs, is really knowing what you need to draw from the company to fund your personal expenses. The next C is around collateral, and collateral is really important because this is the security portion of a loan. So collateral is that backup source for lenders in the event that you don't repay your loan. So if you don't repay, you go into something that the bankers will call default. And when you go into default, basically what the lender is going to do is they're going to try and repossess the collateral so that they are not taking as big of a hit when you default on your loan. So most collateral will come in the form of cash or cash holdings. That is the most valuable type of collateral for banks. And then it goes down in order of ranking from most important to least important. But so it'd go from cash, then real estate, equipment, accounts receivable, inventory, and then personal assets. So that's the way that the bankers are going to look at the value of your collateral. But also important to note that collateral is generally tied to your loan's purpose. So if you were buying a property to operate your business out of, that security would likely be the mortgage. Well, it would be the mortgage. Now, a couple of things that I want to note here. Do expect to be asked for a personal guarantee. I think a lot of entrepreneurs, especially if they set up corporations, think that they're isolating themselves from any type of personal connection to the business. But when it comes down to the lending environment, most lenders are going to be asking you for a personal guarantee. What is important to note is that you will never be guaranteeing more than what the outstanding balance is of the loan or an agreed upon amount. There's also something called a general security agreement. And this is an important security document that the banks will also be asking for, because it allows the banks, if anything ever happened to your business, it would allow the banks to take the first priority in a lending in a repayment situation. So the lenders want to make sure that they get paid ahead of any other creditor that you might have. Some of the other tips that we would have here would be to find out what you can use as collateral and make sure you know how it's going to be evaluated. You'll also want to assess the risks, because if you're putting your house on the line, as an example, as a personal asset, is that something that you're comfortable doing? So I always say, talk to your banker and your lawyer in this regard. Last, we have of the 5 C's is conditions. In any business, there are always going to be favorable and unfavorable conditions that could influence your ability to repay a loan. So conditions could be internal business conditions or external. So internal business conditions could be things like, are your employees engaged enough to be able to help you take the strategy to the next level? External conditions could be what we're seeing now in COVID. How has a pandemic shaped many businesses? These are things that are conditions and things that could impact your business in a positive or negative way. So important that your banker understands that you've given consideration here. When bankers look at assessing this, they will look at your business performance. Are you growing, getting more customers, or expanding? How are you using the funds? If the lending funds are being tied to revenue, you actually have less risk there. And then there's external factors like the economy, how an industry is changing. And finally, some of the terms of the loan, like your interest rate and your fees. If you have a loan that has a really high interest rate, that's a negative condition for you because it's going to impact your ability. You're going to have a higher debt payment. So really important. So my tip around this one is apply for a loan when your business is strong. You always want to go in with a strong position. Develop business credit, because when you have some business credit, it starts to talk to your character and your experience, and know what conditions are risk factors or mitigators in your business. So at this point, I think we're right on time. I'm about 1 minute late, but Joanna, we're going to welcome Pete Molenaar to the conversation, and I'm going to throw it back over to you.
Thank you so much, Shannon. Wow, talk about a lot of information, so many great takeaways there. And, I don't want to spend too much time, but a couple things that really struck me was I really appreciated how you opened with all those questions that entrepreneurs should be thinking about when they are going to the bank. I think that was really practical and really helpful. And of course, really how you peeled back the onion on debt financing, the pros and cons list. Just so many great takeaways, and I'm actually really excited for this Q&A session because I think there's going to be lots of great questions that come out. So with that, we're now at the Q&A portion of our event, and I'm delighted to introduce Pete Molenaar, Senior Vice President and Head of Commercial Banking for Western Canada for HSBC Bank Canada. Pete oversees the delivery of commercial banking products and services, including treasury, trade finance, and capital markets to businesses across Western Canada. Pete has over 26 years of experience in commercial banking, risk management, and credit structuring across multiple sectors, including oil and gas production, energy services, manufacturing, transportation, consumer products and services, forestry, agribusiness, and agricultural banking. Pete holds a Bachelor of Science degree from Montana State University and an MBA from Dalhousie. So I'd love to pass things over to you, Shannon, to kick off the Q&A here with Pete.
Well, hi, Pete. Thanks for joining us. And I love that backdrop. So it looks like you're in a beautiful place.
Yeah, it's better than the bedroom I'm in. Thank you. Great to be here.
Well, thank you for joining us. And, you and I are both bankers, and, it's such a complex environment really for entrepreneurs. And we've got some questions that'll come through the Q&A, but I'm just going to start it off because I just went through the 5 C's of credit with the participants on the line. And I'd love to hear your perspective on what should entrepreneurs consider when they're wondering if they even need a loan.
Yeah, I was able to hear part of your presentation, Shannon. It really touched on a lot of great things. When looking at a loan, I think a lot of entrepreneurs, the key thing to look at, as you talked about, is the capacity. The character and those kinds of things show up in the meeting, but really the capacity. Is the business able to, manage and handle the debt that the entrepreneur is looking for? But even one step further than that is there a good understanding, and is the business able to absorb any shocks, or are there good backdoor, when I say backdoor, sort of backup plan and security or additional capital available for them to be able to absorb any of those shocks? So it's really understanding the business and its ability to manage and repay the loan, but also is there good backup plan, good backdoor options available in the event that something goes wrong, i.e. a default or something like that. So those are some of the key things when looking at that.
I love what you just said, because it is a full picture. When we take a look at a picture of risk, and we just went through the 5 C's, but it's highly unlikely that every entrepreneur is going to have, a perfect story of all the 5 C's. And so when you're telling your story, at least when we know what the banks are looking at, we can really try and hit the high points. And sometimes you have to amplify it in other areas. And it's not like there's this perfect little checkbox that the bankers are looking at. So I like what you said. It's just, its capacity is really important. Obviously, as bankers, we want to make sure that the loan's going to be repaid. So that's a huge consideration, but there's other pieces that do come into play. What are some of the startup loans that would be available to entrepreneurs? I mentioned the Canadian Small Business Financing Program as being one of them, but from HSBC's perspective, where would entrepreneurs start when they're really looking at that startup financing?
Yeah. So, from the loan perspective, you mentioned the CBSA loan, BDC, and not to pick one over the other, but Business Development Bank of Canada is really geared towards helping entrepreneurs and startup businesses get started. And they have a number of loan programs. They're both direct from BDC, but also loan programs that you mentioned in your presentation, where they back and guarantee part of or a major portion of the bank's loans. So, in terms of traditional sort of debt financing, those are the places that you're generally going to go to. There's numerous other options that are available in the marketplace. I think, fintechs are one place to start, which really do focus on what you said with respect to, the personal credit scoring. They actually don't differentiate a lot of times between the personal credit score and the business success. So those are places entrepreneurs can go. The issue there is sometimes the loan is not sufficient enough to get started. There's a couple of, there's, again, non-traditional private equity, but they're generally not looking to get into the smaller end of the market, because there's a Canadian Business Growth Fund that, and I have to declare that I'm on the board of that, but that's an initiative started by all of the Canadian banks and some of the insurance codes that is focused on helping businesses get started. They're looking for a little bit later stage, but they're probably one of the private equity firms that are available out there to enter into businesses a little earlier on and a little smaller than a lot of the private equity that's there. So there's a wide range, and those are just a few of them. And a lot of times your bookkeeper, your accountant, or even your banker will be able to direct you into each local market has what I consider to be entrepreneurs that have started funds as well to get businesses off the ground. So it's a matter of knowing where they are and who to talk to get to them.
Well, yeah, I think you mentioned a really important part of the conversation, which is your networks and being able to leverage bankers as sources of information, helping you get to another place. If they're not ready for traditional financing, your banker will be able to make connections to you to other developmental agencies, which could really be a great starting point for entrepreneurs. And you mentioned BDC, and I think a lot of entrepreneurs think that the banks can't work alongside of banks like BDC. In which case we often will work very closely. And I know that BDC will sometimes, they'll take a second position when it comes to security. So, that's probably getting a little bit too deep here, but we do work and have a wide network to be able to support entrepreneurs. From your experience, what are some of the most common mistakes that entrepreneurs and more in the startup would do when they're approaching a bank for a loan?
Yeah, that's a great question. And I've actually thought about that one and figured it may get asked. So the answer I'm going to give, I don't want it to come across negative, because I don't. Some of the biggest mistakes I've seen in my career is that the story, they focus too much on the story and not enough on how is the story going to be backed. So, and you mentioned, we're very focused on risk and getting our money back. And I don't want to paint us in a bad picture. We do focus on risk though. And, making sure that, entrepreneurs are highly passionate people. They have to be to do their jobs. And that's what drives this economy. And that's what drives so much of the success that we have. And entrepreneurs, everybody on the phone, and I'll say this over and over. I said it at a podcast event with Business of Vancouver too. Like that is what drives our economy. So that passion is so needed, but don't let the passion overcloud the understanding of you understanding your risks, of you understanding, concentration of cash flows, or understanding your balance sheet and where that's growing to and how you're going to finance that. Love the story, and you got to have that story, but don't let the passion of that story overcloud the understanding of what the banker's going to look for. Because if you don't address those things, the banker's going to go away and try to figure them out on his or her own. And you don't want that. You want to control that conversation. And so make sure that you're balancing that passion for where your business is going. I've seen it so many times. Focus on sales and markets, where this thing's going to explode into. And the banker's sitting there saying, well, they're just going to outgrow. They're not going to be able to keep up. And so always be ready for that conversation as well. And don't let the bankers dictate that conversation or go away and come up with it on their own. Make sure you give them what they need from your perspective.
I think that's such a great answer. And, even my experience in banking too, I always loved getting behind the entrepreneur. I always loved the story, but I needed the substance, because I think what entrepreneurs also don't realize, you're selling yourself to the banker. The banker then has to go ahead and sell your business to the, the risk department. And ultimately there's another layer of decision making there too. And so, yeah, I think that's just such wise advice. And you hit on something else so critically important, which is that financial literacy piece. Like, I can't say enough about the importance of having entrepreneurs really understand the financials and how the financial story is moving in their company. So thanks for bringing that up. But also, again, the 5 C's, like this is how the bank is going to look at it. And so when you address this is all a game about risk, really, at the end of the day as well. I kind of like that, because you can kind of move things around, but really like not letting the story be overshone by the important pieces that the bankers are going to be looking for. What documentation should entrepreneurs be bringing to a bank meeting?
Yeah, there's another great question, and it's a very simple. We as bankers think it's a simple question, but it's a lot of people don't really know. Like, so the first thing we always try to look for is history. So to your question on character and what's the history, and a lot of times entrepreneurs don't have that. But if you have three to 5 years of financial statements, even if it's not in the business you're coming to the bank with, but a previous one, that's very helpful. The second thing is the real focus is understanding the cash flows and the go forward. So quite often bankers will look for a minimum of 2 years of cash flow, maybe more if there's term debt being involved. If it's an operating credit, which is usually a 1-year facility, they'd still want to have 2 years. And the first year of those financial documents, of those forecasts, should really be on a monthly basis. So how are the revenues going monthly? And then layered into that is, how are the covenants? So how's your working capital? How's your debt service ratio? Each month showing that. Second and third year out, you can probably move that to quarterly. You don't need to maybe do them monthly, because by then, the business is established and got some groundwork behind it. The other thing that I don't think enough bankers ask for is back to what I said earlier, is really having a good understanding of what your risks and your mitigants are. And you don't always have to have a mitigant for every risk. I often find people write the mitigants first and then the risks, so they don't have a mitigant less risk. But if you don't have a cover for one of the risks, make sure that's where your backdoor conversation comes. If you have additional equity somewhere and things like that. So having a good understanding of your risks and mitigants. And then the final thing, it's almost like your CV. There's nothing wrong with bringing your resume, what you've done in the past, to the conversation. We get to know each other very well through the conversation, but getting to know the person, I'm a little more old school. And you said gut lending, and I was always accused of being too much of a gut lender early in my career, but I really did. And I still do to this day, put a lot of credit and reliance into the person. And frankly, the banks are getting better at that all the time. So don't be leaving that piece uncovered as well. So it's really 2-3 years. If you can get a historic financials, forecasts, showing your covenants, a good risk and mitigant piece with what are some backups if you need them, and then a little bit about yourself. And those are the key things that I think you should bring into those meetings.
Yeah, great point, Pete. Thanks for all of those. I want to ask you too, just circling back on HSBC, we've got a couple minutes left here, but how is HSBC uniquely positioned to support entrepreneurs, particularly in a global, looking at it from a global market perspective as well? Did I just freeze?
No, I think Pete's frozen.
Okay, so while we're waiting for Pete to come back in, sometimes technology plays tricks on us. And of course, it's right at the part where HSBC can toot their own horn about all the great things they're doing. But we have a question here from Aaron. What are some of your most recommended resources for increasing your financial literacy in the early stages of a business? Thanks, Pizzicle. Okay, that's really quite funny. I haven't seen that before. Thanks, Randall. That was a good one. I saw your question there too. So there's lots of online resources that you can look at. BDC, I know, has got some financial literacy. A lot of the developmental agencies also have financial literacy programs. And so there's lots. I would just suggest doing a Google search and you will find a whole bunch come in. Aaron, I'm certainly happy if you want to put your email to us as well to get you some more direct emails. And Randall, to answer your question, yours was about how social benefits or impact financing differs from conventional financing. I have to be totally honest, this is still an emerging area of financing. When we take a look at social enterprises, I don't know that I'm going to have the right answer for you here, but again, if we can get your email, and I will make sure that I send you some information. I know that there's some mapping being done right now that is looking at it, but it is trying to look at more bringing of the passion, the purpose, not just being profit first. And so I hope that helps for now, but I will. Yeah, thanks, Randall. I'm just going to copy this right now, and I will make sure that I do send you some more information there. Pete, you froze on us, and Randall called you a pizzicle. I haven't haven't heard that before, but I thought that was quite smart. And I was also just saying, like, of course, leave it to when I'm asking you to talk about how HSBC is uniquely positioned for it to freeze up. So I'm going to give that final question over to you, Pete.
Okay, I hope my frozen face wasn't like really out there weird. I hate that. So what makes us unique? So I was with a large Canadian bank for 24 years, and then came to HSBC 3.5 years ago. And it's just not a judgment of any bank, but what I found the difference that we really bring, I think, to the table is because we're such a global organization, we really do need to find unique ways to help our customers, particularly grow globally. And that often takes a very deep understanding of the customer. It takes an understanding of different risks. We often can find ways to finance businesses working capital with very little capital in from them, just because global sales often take so much time and go quickly. And so, I think there's that sort of DNA within the organization that really requires us to dig deep and explore all the avenues and go down a number of rabbit holes, as I call them, in order to help our clients go global. That does resonate back into our Canadian business as well. So a lot of our products that are built for global growth and global finance also support domestic businesses as well. So I do think that we have a little bit of an advantage in some ways, just because of that DNA. And we do have a lot of people within the Canadian commercial banking business that came from Dubai or the UK or Australia or Asia. And that just brings in the Asian markets, and European markets are completely differently financed than the Canadian markets. They rely much more on sort of receivable finance, which is a lot higher advance rates than what we do here in Canada. So all those ideas are brought into the Canadian market through an influx of our global movement of people as well. So there is a bit of I've noticed there's a real difference in our approach that way in particular.
Thank you. And I mean, obviously it's so important as borders kind of come down when it comes to the world of business. And so thanks. And I think we all know, getting off of airplanes when we used to be able to travel, that we'd often be greeted with HSBC ads too. So certainly know that HSBC is a leader in the global space. Pete, I want to thank you greatly for your time. I know that it's not very often we get a vice president joining us on these calls. So thank you for making this a priority. And thank you for also to HSBC for supporting the AI3 webinars. This has been a huge help, especially as we focused on helping more marginalized, underserved, and underrepresented entrepreneurs in Alberta, and building a more inclusive entrepreneurial ecosystem. As I also want to thank everyone for tuning in today. Time is precious for all of us, and there's lots competing for your time. So thank you for spending it with us. And I also want to mention that as part of AI3, the Diversity Institute has teamed up with Mount Royal University to offer a series of no-cost workshops on the fundamentals of entrepreneurship. The workshops are going to cover topics such as marketing, financial literacy, Aaron, Excel for business, and more. These are going to be held virtually every Wednesday evening in March. Joanna, if you can put, you've already got the information inside the chat, that's fantastic. So feel free to join us there. We look forward to joining you there. To everyone, stay healthy, stay safe, and we are always here for any questions that you have. So we'll have this, everyone's going to get a good copy of this. And also with respect to financial literacy, I just want to circle back really quickly to Shauna's presentation last week, because she had some great tips in there as well about what you should be looking at from a financial literacy perspective. And I think she gave a great overview that day of the highlights. So thank you, Pete. Thank you, Joanna. Thank you, Diversity Institute, HSBC, and the AI3 community. Thank you.
Thank you very much. All the best, everyone.
Thank you.